So one last audio check. We've got about 2 minutes to the top of the hour. Just wanted to thank everyone for taking the time out of their busy Friday to join us for our session on cost savings and return on investment, very much focused on how to actually leverage artificially intelligent contract lifecycle management solutions to reduce your operating costs, and not just on the legal team, but to actually save money for your company. So for those of you attending with a little bit more of a bent towards procurement contracts, this one's for you. We're about 2 minutes away from the top of the hour, so we'll continue to give some time to folks to join in. As a reminder, you'll all be placed on mute, but you will be able to ask questions throughout the event through the Q&A tab. From a housekeeping perspective, we will also be making an on-demand version of this available for you afterwards to review or to share with your friends. You can tell it's Friday, we get a little bit more casual. If there are any issues with video or audio, well, if there are issues with audio, you probably can't hear me speaking anyway. But do reach out to Ultria Inc. On our WebEx. That is our host, and they will be kind enough to take care of any connection issues you might have. I see we still have more attendees coming in, so we are going to just, actually, I'm just going to give it another 30 seconds, and then we can get started. I lied. We got 2 more people just joined in the last 15 seconds. We're going to give it another minute, but no more. So we've just about hit the top of the hour. I'm going to take just a minute to go over some housekeeping, and then we'll get started. For those of you who are time fenced, the session is like our others for our Frankly Fridays. We try to time these out for about 45 minutes. That'll give you time if you're working from home to get to the kitchen before the kids do, and to get a quiet bite to eat before everything goes nuts, or your significant other steals whatever's in the refrigerator. For those of you who are in the office, like myself, I know it's good to be back. So thank you for taking time out of your morning or afternoon, as the case may be. My name is Arthur Agat. I'm the Executive Vice President and founder, or co-founder, of Ultria. And I'd like to thank you very much for attending our session today, which is the last of our Frankly Friday sessions that has been focused on return on investment for contract lifecycle management solutions. Today's topic specifically is how to leverage artificial intelligence-powered CLM for hard currency or hard dollar cost savings. As promised, I've killed my video just to help with the audio bandwidth. Throughout today's event, please feel free to ask questions through the Q&A tab, or if really desperate, use the chat tab. If you're having issues with the video or problems with the sound, please let our host, Ultria Inc., know that you're having issues, and they will try to walk you through them. Otherwise, I think after 100+ days in this sort of work remote, work from home, we've all gotten really used to Zoom, WebEx, Teams, etc. So no real reason to bore you about me. I think many of you have heard me before. I do come from a little bit of a procurement and sourcing background. So I'd like to think that when we speak about how you can use advanced contract management solutions to help really drive hard dollar or hard currency savings, this comes from experience over the course of well, more than a decade and closer to 2. So we'll keep the agenda pretty light today. We're going to keep this to 45 minutes. Just a very high level contract management overview, cost savings, one slide, and then jumping right into how to save money and actually reduce costs in real time, this month, this year, and be able to use some of those savings numbers to maybe roll up into a business case in case you're in an organization that is on something of a budget freeze and you're looking at either getting a brand new contract platform or swapping out an old contract platform or simply adding to an existing document management platform for contract analytics. So we'll talk a little bit about the cost savings approach and how a business case may be best structured in some very practical ways. So our prior sessions have been focused a little bit more on the sell side, revenue increase, and sort of looking at top line dollars. Today, we're going to focus really on the bottom line. And for those folks who are on the call who have a procurement background, I think we all know that every dollar or euro or yen saved is the same as a dollar or a euro or a yen, same as 10 sold. When we look at cost savings in the negotiation process from a sourcing and procurement perspective, it's not uncommon to look at negotiated savings through the contract negotiation and sourcing process as having a certain level of contributory value. And then what happens is there's a level of savings leakage. And this leakage is caused by implementing new contracts, maybe not implementing them particularly well, having challenges maintaining contract compliance with your suppliers. And we see on average between 14 and 24% leakage in the negotiated savings. So your sourcing team, your attorneys, you've worked hard, you've come up with the best deal of the century, or at least for the next 5 years that the contract runs, but there's still money left on the table. Now, what can we do to make sure that we can recapture, or at least not lose, that 14 to 24%? And a lot of that is really by being able to enable higher performance of both your team and your supplier's team. And doing that through a highly visible, highly accountable process for post-award compliance. We often worry about getting the best deal on paper, but forget that it is the actual running or operationalization of that contract that drives actual savings. Purchase the same quantity and quality of goods or services this year as you did last year at a lower cost. And there are a couple of ways that happens from a sourcing perspective, but there's some great ways that contract management helps us do this. Now, I'm sure I'm probably preaching to the choir, so to speak, for many of you today, but 4 out of 5 CPOs clearly indicate that saving is their top priority. What the other 20% or 1 in 5, what their top priority is probably looking for another position, right? So it's pretty key that procurement organization, especially in a recessive market as we are in today, their number one driver is cost reduction. And all kidding aside, their second driver is going to be compliance. So compliance both with industry or company practice, but also regulatory, environmental, and sort of health and safety compliance items. So this is both a job where the value of a contract that can be exposed and managed both supports the primary goal of cost savings, but the compliance around it can also help with your other regulatory alignment issues. The importance of a contract, of course, is that 80% of revenue for the sell side organization is tied to contracts, and a higher percentage of that in sourcing, right, is tied to contracts. So if I look at the percentage of spend managed by contracts, theoretically should be very, very high, unless you've got a maverick spend problem. We'll talk about that in a little bit. The quote here in the call out box to the right, managing contracts effectively can recover significant savings. Absolutely. And then the CFO quote, every dollar saved the same as $10 sold. That varies across industries, but it's anywhere from 1:6 to 1:12. How do we save hard dollar or hard currency through contract management and contract compliance? And we'll step through some of these over the next few slides. But in summary form, being able to reduce costs through contract consolidation requires that you've got insight into individual line items across contracts. And you may even have the ability to further sort of consolidate transactions with a smaller number of vendors once you understand what the relationship between vendors may be. We just ran across a particular marketing budget item where we were over the years working with 3 different suppliers, and all 3 of those suppliers had rolled up into one, giving us almost an immediate leverage to come back and say, okay, here's the true value of our relationship, and what can you do for us now? Interesting little story there. And I know it's not at the same scale for many of you, but the interesting part for me was the vendors had no idea that we were able to figure that out so quickly, and were not happy with us being able to use this information for additional leverage. I mentioned the term maverick spending earlier. The idea there is to bring spend that is not currently on contract into existing contracts with your contracted suppliers. It is so frequent, and I'm sure each of you run across this, that parts of your organization may step outside of the normal sort of rules and rails and buy products almost on an ad hoc basis, without the involvement of your sourcing team perhaps, but certainly not taking advantage of the negotiated contracted pricing that your team worked so hard to take care of. An easy leave on the table. Being able to get in front of, or on top of, or in advance of auto-renewable contracts so that you have the opportunity to renegotiate or even to decide whether or not to continue. They say time is money. Certainly true here. Much better to be well thought out and planned rather than react to a vendor saying, oh, by the way, our contract expired 3 days ago, but it automatically renewed, and thank you for your business. Not having the chance to improve. Avoiding penalties and late payment fees, certainly something we see just in terms of very straightforward commercial obligation management. Restructuring a supply chain relationship, both in terms of how you buy, as well as, to the last item, when you pay. It's not always about cost. Often it is, and it should be, but sometimes it is also about cash flow. And if you are on the buy side, contract side of our world, you want to be able to optimize both your savings and your cash outlays. So I promised that we'd hit some real numbers, and yeah, these are softened somewhat, but these are from real customers, and we can talk offline, put the dome of silence, and sort of work through some of these things as you wish. But let's just hit you up with some very high-level approaches. If you've got sufficient vendor visibility through contract analytics to identify potential savings opportunities, this is locations where you've got identical or similar vendors or subsidiaries or related entities that are selling you the same or similar items, and you have the ability to combine into a new contract. This effectively allows perhaps a volume level discount simply because you've increased overall deal size. You go a little bit farther, and you may have the opportunity to consolidate on a, let's say, regional or national level to increase individual line item volumes to take advantage of predefined and pre-negotiated volume tiers. Now, if we look at what's possible or what's realistic, just to sort of take a somewhat average example, if you're running an $800 million addressable spend organization, when we say addressable spend, this is spend that you can negotiate the price of, because it perhaps is not necessarily, let's say, a raw commodity, i.e., iron, or or number two grade coal, right? Or Texas sweet crude, okay? Things that you're not buying on the open or the spot market, but where you have negotiation leverage or power. Out of that 800 million in addressable spend, it is not uncommon, or to take it on a more positive bent, it is very common to see at least 10 million of that to be consolidatable into a fewer number of vendors or into a fewer number of contracts with a reduced number of vendors. What that does, just by the way numbers work, is if I normally contract 5 different parties and I reduce that now to 3, I'm increasing my volume for those remaining 3 by 10, 15, 20%. That jumps you at least 1 or 2 pricing tiers, and you will see between 3% and 8% reduced cost as a result of that simple effort. Now, using numbers on the conservative side, let's say 3 to 4%, on that 80 million, you'd be looking at a net cost savings of $2.4 to $3.2 million as soon as you use that contract. So assuming this is an annual volume, not bad for that particular segment. Being able to restructure these vendor relationships through this kind of increased collaboration and visibility may also identify additional opportunities for cost reduction. And these get beyond those things that are, I'll say, easy or low-hanging fruit tied to contract visibility, but get into sort of as-build or could-build level price strategies. Another place that contract visibility helps procurement organizations reduce their costs is by being able to rein in or reduce what we might call, maverick spend. A Harvard Business Review quote estimates that between 5 and 40% of the value on a given contract can be lost due to ineffective contracting policies and procedures. One major way that can be improved upon is to provide for your suppliers the ability to bring in or to leverage maverick spend. What this may mean is that you put clauses into your contract that forbids orders to be placed with contracted suppliers through non-approved channels. Simple example, let's take our favorite office supply or indirect goods vendor that has both retail operations as well as wholesale operations. And you've got employees that are running out back when you would work from the office, running out to these particular stores and paying a retail price and still looking for an additional level of discount based on a business card or an employee ID. These retailers gladly extend 5 or 10 points, take the business card, say thank you very much, and the transaction is completed. Your wholesale pricing that you negotiate on a regional or national basis is typically between 17 and 19% savings. So just the fact that they're taking these transactions at point of sale, you are losing 10% of your negotiated savings. By putting a clause into your contract that says, if you shall do this, i.e. take point of sale, and we catch you, and we will, you are then going to rebate us the difference between the discounted point of sale and our negotiated wholesale pricing. And by the way, that sounded very hostile when I said it, but the reality is these big box or equivalent office supply stores are more than happy to take this business every single day because they know that you will let your people loose with your procurement cards and their reimbursable charge cards and increase volume with them as vendors overall. So it's good for their top line, maybe not so good for individual store level P&L when the monthly rebate reports come out, but perfectly worthwhile and a great little strategy. just as an example, we'll take that same 800 million in addressable spend. And based on what we've seen sort of historically, it's not uncommon to see a fairly large percentage of maverick or off-contract spend, in this case 120 million, that can be reined in. Now, of that 120 million that is not currently going through large contracted vendors, let's be somewhat realistic and say that you can address 1/5 of that, or 20%. That means that 24 million of that 120 could see net, well, let's average 17 and 19 to say 18% savings, and that will translate to an incremental $4.3 million. Now, that 4.3 is then added, by the way, to the 3 mil on the previous slide. And, well, $1 million here and $1 million there, pretty soon we're talking real money. Renegotiation of auto-renew contracts. This is being able to get in front and know that you've got a contract coming up that is going to automatically renew. Gives you an opportunity to reach out to the other party. Rather than just take the default terms, gives you an opportunity to say, do I really need this to be an auto-renew? Do I really need the exact same terms? If I threaten to pull my business, how much do I get? We've all been recipients from our sort of, I'm sure it's happened to all of us, that when we have a customer will send us an email or send us something on a FedEx envelope and say, we're asking all of our valued suppliers to reduce their costs this year by 7% or 8% or 15%. If you don't ask, you don't get. But in our world, let's just say that with advance notice, you have the opportunity to get into a collaborative and open and accountable conversation with your key vendors and negotiate a 5% discount. Straightforward math. If 25% of your procurement contracts are auto-renew and the value of those contracts are 100 million, and you can adjust by 5%, that's a good, clean 5 mil back to the bottom line. Avoiding penalties and late fees is an interesting challenge. I think late fees, very, very clear. You know what your payment terms are. You know how they can play to your benefit. You negotiated very hard for them. Stick to them and avoid the penalty interest fees that come with. Avoiding other kinds of penalties for either performance or confidentiality breach or the like. Here the challenge sometimes when it comes to putting together a value proposition is, what have you paid in the past? Now, as a vendor and as someone who actively licenses and sells contract lifecycle software, we know this is a pain area for many companies, but also most companies are very closed mouth about sharing that information. What we have found just by talking with our customers is that after they see that their average penalty payment over the course of a year is reduced between 25% and 50%. And this is because they're simply on top of things. The contract platform warns them, gives them advance notice, and in the case of obligation or performance tracking, indicates to both parties when they may be heading towards a non-compliant or possible breach situation. Take a 5-year average across, the last 5 years, factor that down by 25 to 50%, and this number could be sizable. Restructuring the supply chain relationship is an interesting approach, and it's one that we're seeing certainly more and more in the last fiscal quarter. It's good to start looking at contracts where you may have a periodic replenishment, or you've got a quarterly buy with a minimum volume level in order to maintain your discount structures. Given the general market or industry slowdown, this is a great time to identify those clauses within those contracts using contract analytics like available from Ultria CLM or the Orbit contract analytics platform, And then reach out to those members of your value chain, right? These are trusted partners. They're not just suppliers. And have an open conversation. You know, you need to have good business for them to get business in the future. Reestablish where you may be able to either increase standardization of parts bought to meet up with some level of volume requirements, work on your FOB terms, your ship terms, see how you can lower your logistics costing. And last but not least, think about what contracts you can put temporarily on hold or pause during particularly slow or during times when government intervention has caused your business operations to cease. On a somewhat brighter note, try not to sound too depressing, is what you can do when you start looking at structuring payments differently so that you can meet your existing cash flow requirements. And this is true whether you are a $500 million company or a $50 billion company. Cash flow is probably as important as cash is at any given time. So having the CLM visibility to understand what your obligations are and what those payment structures look like give you the ability to restructure and do it with knowledge and a forethought to both end up with a more positive relationship with your value chain partners, as well as be able to quantify those results. Using this free cash flow, of course, to pay those salaries and expenses and invest back into a growing business. So, some of the more straightforward ways to restructure cash flow is to tie payments not to the month or to a period basis, but to milestones. This way, you're paying for those things that you are receiving. It's sort of the reverse of revenue recognition, but very much in lockstep. This enables both you and your suppliers or your vendors, partners, to have an open relationship so that there's predictability in cash flow all around. And of course, just from a maybe an obvious statement, but start with your high spend vendors because that's where you're going to get the biggest boost in your cash flow. And an enterprise-wide, full life cycle contract solution really does provide that unifying collaborative platform to communicate back and forth. Using things like a supplier request portal where you can post statements of works or task orders or contract deltas for those sort of trading partners is absolutely key. It gives everyone a single place to view it, and increasingly we're getting used to things like the new normal, and it's sort of a cliche term, but increasingly with people being more comfortable working remotely. Being able to access multiple systems through single sign-on and through browsers and through email, although convenient and increasingly more common, there is something to be said for having a single entry portal so that your key suppliers can come in and see all of the communications that you have for them. Performance notifications, change orders, new tasks, both the good and the bad. Now, there are certainly some of these hard dollar or hard currency savings, and we see things anywhere from 5% to 19%, depending on the categorizations. And the realized cash value is still substantial. It is not unexpected to be able to see, 10% reduction in certain key categories of indirect and addressable spend. Direct spending is a little bit more of an art form and not so much enabled through the AI-empowered contract management, yet contract performance certainly can be. So being able to step out of the comfort zone of having your contract simply locked in a repository, but being able to get increased visibility through AI becomes a tremendous enabler when you can bring forward your legacy agreements and the business value encapsulated within to improve the performance of your current contracting process. What that enables is based on lessons learned through contract analytics to speed up your intake request process by leveraging the learnings of your artificial intelligence and embedding within your robotic process automation. By being able to leverage past contract analytics into developing more robust clause and template libraries, or as some of our customers call them, playbooks, to allow both faster and more, I don't want to say accurate negotiation, but let's just say resulting in more favorable negotiation results by both the playbook and by using structured templates and clauses in the authoring environment. Further, then taking a streamlined approach to approvals so that only the people who need to approve something are involved, reduces extra headcount, wasted inefficiencies, and then increasingly with today's geographically disparate teams, being able to leverage electronic signature, mobile access, and embedded communications to enable faster execution. Now, faster execution to me, and we'll wrap up on obligation and compliance in a minute. If you've negotiated hard for savings, the faster that agreement goes into effect, the faster the savings start to flow. So this is one of those areas where the intake to execution stage has an immediate cash value. We had some examples before, 3% of 800 million, right? 24 million, 2.4 million, whatever your numbers are. But if I've got, let's take a nice easy number. If I expect that I'm going to save, because of this negotiated contract, $12 million in a year, that means it's $1 million per month. If I can take a month out of my contract close cycle, that's an incremental $1 million. And again, $1 million here, $1 million there. Pretty soon you're talking about real money. Obligation management is really about being able to capture those savings that you've negotiated so hard to take care of, as well as to avoid any kinds of penalties, but also for you to demand any kind of entitlements from your suppliers. Entitlements might simply be discount fees, rebates, refunds, etc. Moving past compliance into that sort of 20% of the CPO function, and just keeping an eye on my time here, let's talk a little bit about renewals. We talked about being able to get in front of automatic renewals, and that is absolutely great, the auto renew clause, but also being able to get sufficient notification prior to any normal renewal. Give you and your category management or your vendor management team sufficient time to put together a sourcing strategy or renegotiation strategy. And we know that with a little bit of information, your team members can be incredibly powerful. So we sort of run down a couple of use cases, whether it's consolidation through visibility, whether it's maverick spend through better negotiation and also a level of visibility, or performance and compliance through obligation mapping. But it really comes back down to, do you have a CLM? Are you looking to expand one? And how do you get someone to fund it? I mean, we often think about contract management teams as being a cost center. On the revenue side, we consider it the Revenue Prevention Society. In procurement, procurement is almost always a cost center that has sometimes a hard time justifying a budget increase. So how do we go about facilitating a business case for enhancing contract management, whether it is through sort of taking that extended savings and ROI, which we covered in our first of our 3 sessions, or revenue resiliency and growth, which we covered 2 weeks ago, or really looking at hard dollar cost savings. So we look at hard currency cost reductions, and this is arguably the most powerful business case for getting funding for a CLM project when you are in a bear or a recessive marketplace. This can help change your stock price. We have multiple customers that have been able to take between 10 and 20% of their costs out of the equation, which has a material impact on their P&L, their balance sheet, their income statement, and has a generally very positive impact on the bonus structure of the financial analysts, legal team, and procurement folks are related to the effort. You're looking to bring off-contract expenditures into existing contracts. That is both sort of maverick spend control, but also being able to increase volume level discounts. getting you in front of your auto renew contracts to negotiate more favorable rates, giving you the ability to avoid performance and payment obligation penalties, and arming you to better restructure your supply chain relationships and restructure your cash flow payments. Being able to communicate this to either the head of procurement, the head of finance, legal operations lead, can be a bit of a challenge for some. So we don't want to sound condescending, but maybe we'll just share a couple of data points on what we've seen work well for our customers in the past. So once you've been able to sort of, get that budget carved out from your leadership, now we need to be able to look at additional optimization. So team performance optimization, estimate 10% cost reduction across the team. Being able to reallocate labor to other teams, 10%. Reducing outside counsel spend for procurement contracts comfortably by 20%, and reduce actual indirect procurement costs by 5%. Now, this is what you might have committed as part of your business case. These are very tangible, very measurable numbers. So you will want to be able to measure this throughout the rollout process, from your proof of concept to your pilot to full release. And you want to measure everything you can for both pre-award and post-award. Now, I mentioned that you might be doing this in a proof of concept or a pilot or a full release. And some of you may say, well, what's the better way to go? If we know we're going to save money, do I want to suggest a rollout that is effectively as broad and as deep as I can, or are there other alternatives? Now, there's no right or wrong answer here, but there are factors that can help you decide what's right. And working with your partners and advisors and consultants, or even your experienced CLM vendors, can help you quantify the impact of some of these factors and how you make the decision. So the first, and I skipped over it too quickly, is time. How much runway do you have before you need to show results? When you committed to a business case that was going to save X tens or hundreds of millions of dollars, did you also say, oh yes, and we're going to do this soon. We're going to do this next fiscal year, or we're going to do this on Tuesday. So your runway matters a little bit. And I'm being facetious, of course, about soon and next Tuesday. And then scope. Are you looking to deploy a solution across the entire organization to maximize value, or are you looking at an organizational construct that might be more manageable? Is it across a series of commodities that you buy? Is it across a series of organizations that you may service in case you're a shared services organization? Or do you just pick up huge parts of the world and say, this is good for North and South America, this is good for EMEA, this is good for ANZ, Australia, New Zealand, and just sort of chunk it into pieces? I think it's where you start to look at the risk and rewards. So the faster you need to roll something out, the more limited in scope you'll probably want, and you'll want to pick a scope where you've got both friendlies as well as cynics. And the reason for that is friendlies will help you. That's sort of a given. But if you can convert a cynic, it's the same as bringing 10 friends along. So, choose wisely, as they say on the big screen. And then what kind of resources do you have? Are the resources third party? Are you paying separately? Is this another budget item? Are you using an internal team? If you're using an internal team, make sure you know what other priorities they may have. Your PM team, your project management team, or your IT services team, they may be in the middle of a large SAP rollout or an Oracle rollout or something big, or they're putting out a new HRMS package. or you've just lost half your team to some influenza-related work from home thing. World is uncertain. So if you've got the time and the runway is long, do a pilot and more than just a proof of concept. So a proof of concept, many people think of, it's a free, almost like a let's try something out to show that proof of capability or proof of concept passes. A pilot is to pick a very reduced scope, and that could be function, it could be contract type, it could be geography, and show that there is value to be had, and that it gives you an opportunity to also look at what the impact of change is to your organization. Next would be to limit, and I think we talked about this, limit some of your scoping so that you can comfortably get your arms around this and both manage your friends for positive amplification of a good story, but also manage and convert a cynic or two. When it comes to risk reward, it's certainly a deeper story. There are aspects of your CLM rollout that have immediate value and relatively low risk. There are others that will have certainly higher value, but may have a medium to high risk. Look at the impact of organizational change through your pilot process with limited scope, and this will help you make a determination as to how to maximize your reward and minimize your risk. Likewise, take a look at your incremental resources that may or may not be available across any of your particular scopes and time zones to make sure that you use your resources well. There may be very high return regions that if you were to expend a little bit of extra resource cash or budget would have a amplified or multiplied payback. They say, what is the right time to do this? And this is not my call to you to do this now, though our sales and marketing team would very much like me to say that. What is important is that when you discuss this with your budget holders, with your resource holders, with your key stakeholders, that you express to them the importance of doing it at a particular time. If you have an important event coming up, and I'll use an example, you've got a merger and acquisition coming up. You're going to pick up all of the contract activities from another company, put a new system in place yesterday, okay? Prepare for it, do your internal change, do the change so that it is more manageable. It's a great time to bring people from a new organization into yours. Great time to roll everybody up, train them at once, get started now. The other might be more of an IT operational thing. I've got a swap out for a procure to pay or source to settle platform, since we're going to have everything up in the air, and I've got a huge training budget and I've got some staff supplementation. Let's tag on to this. Let's add a contract, lifecycle solution to that particular project. Timing is everything. Thinking about timing too, though, is reminding people what is the cost for not doing something. They say that there's always at least one option, and when it comes to doing something, and that is always, of course, to do nothing. If I know what my net average savings is going to be for a successfully renegotiated contract, and the only way I can do that, granted that's a little bit of a stretch, might be to have a new CLM, I certainly can factor to say, if I had a CLM, I would increase my net new savings by 5%. That's money I'm not going to be able to recoup. It's cash I'm not going to be able to keep. It's improved cash flow and relationships that I'm going to be missing while we're not doing it. So it's a great sort of spreadsheet exercise, and it's tangible value. And I think many of you will find that when you're talking in hard currency, hard dollars, to your chief procurement officer or his immediate reports, and you're talking to the finance team, they understand it. As we're wrapping up our 45 minutes together, I do certainly offer to everyone on the call, take advantage of our cost savings calculator. It is a very practical approach, and certainly using your numbers and adjusting your factors will give you an excellent view in terms of how a contract lifecycle management solution like Ultria's CLM can help your organization reduce cost. And it is very exact. We have all of the math behind the scenes and fully exposed. And we certainly have associates that can walk you through this process if you are unsure. So a little bit about us as we wrap up, and then we'll throw the floor open to questions. What is Ultria? Ultria offers a couple of AI-powered solutions, certainly focused in the contract management and contract analytics space. So contract authoring software leveraging AI engine for intake wizard approach. This reduces the cycle and input time by a factor of 10. Being able to extract metadata from third-party contracts, which is often the case in procurement, that we've got at least a statement of work or a task order coming in from the vendor, being able to disassemble that and pull data from it for routing and for appropriate triage, but also using values to route for particular category managers review or appropriate financial or risk sign-offs. Being able to perform contract post-award obligation, performance, and compliance management within the CLM so that those goals that have been memorialized in the contract can be used as baselines, and your operational data can be compared against it to trigger action by your contracting team and even the vendor themselves. That leverages the artificial intelligence for clause and obligation identification within the platform. And then last but not least, in the lower right, is our Orbit for contract analytics. The Orbit sort of brand of Ultria is focused on a standalone artificial intelligence engine. It's basically our standard engine in a mode that can be connected to other systems. So you may have a document repository, or you may be looking at a merger and acquisition, and you want to do a supply chain risk analysis. This enables you to run metadata extraction, clause identification, and risk analysis across any collection of documents. So Orbit is the engine that runs as a guide in the intake process in the Ultria CLM. It is both the metadata explorer and clause extractor within the Ultria CLM, and for contract analytics as a standalone or a bolt-on to your content management or document management platforms. We got a couple of questions. Unfortunately, we are out of time. For those of you who did fire questions off, I will certainly look to get these responded back as soon as we can. Thank you very much. Again, this is Arthur Aguette with Ultria. Enjoy the rest of your day and a good weekend ahead. Thank you.